All right. Good morning, everybody. Here's your NDX, NQ, SPX, and ES spot gamma levels. All right, we have additional auctions today, and in the overnight hours, Japan's got a lot going on. Between now and tomorrow morning, the shape of the market can be completely different. Now, this is something a lot of people are sleeping on. It's not getting a lot of traction yet. And, with the head bobbing media, they're really reactionary. Rather than, giving a heads up, something like this is coming, they're just going to cover it on the other side. Like, oh, wow, look at all this angst that's happening because of the information that came out. So Bank of Japan has a new leader, and one, there's the chance that he'll say something that is either intended or unintended and takes the market in a direction. Or two, now that this is his mess to clean up, he might start discussing the yield control that Japan has been experimenting with for a long time. There's so many things that are on the table and unknown with what's going to happen tonight. So really consider what you're holding in your portfolio as we come into this. And there's really no way to game it out in advance. Like, well, this data says we're going to go up or down. It's going to be more like an earnings event where it could go either direction. Of course, nothing has to happen. It doesn't need to make a big move. It doesn't owe us anything. So, don't go piling into out of the money stuff thinking you're going to see some big move in the market. There's just a really big threat right now tonight because of Japan and what's going on over there. So don't be surprised, you get up tomorrow morning and you're looking at a completely different marketplace. There's a little bit here that stands out. So far, American corporate, let's put this over where I can keep it. So far, American corporate results have outperformed estimates by nearly 3/4. So a little over a year ago, around this time, analysts were starting to get dogged on Some agencies were giving them grief because analysts really hadn't changed their recommendations. They hadn't changed their calculations, forward earnings outlook, nothing. They were just leaving companies the way they were. And think about where we were a year ago, right? We were still headed to the downside, strong bear market. And analysts still hadn't come out and made any changes to their recommendations or their outlook or their output on names. Then they went in after getting enough grief and started making some changes, but they're way off and they continue to be way off. And we can see this here where they're missing not just the analysts themselves, but also companies and corporations on what they gave for forward guidance. So maybe they were lowballing, or maybe things are just that strong out there. So looking at the economic impact scale here, nothing really stands out past 8:30. So we should be good to go at that point. Just keep your eye on this evening. We do have additional auctions today as well. Very close front end stuff, the 3-month, the 6-month, and the 4-week, but we have the 7-year as well. That one's an oddball. I mean, I wouldn't never recommend ignoring data, but I don't see this one as being very impactful. Just my 2 cents, throw it in there. Still, after we're done with that auction, should be good to go for the afternoon and your 0-day plays and everything like that. Europe closes at 10:30, and I'm going to continue to remind you to watch the clock at 10:30. All right, and it doesn't have to happen right on the dime, like, oh, it's 10:31. I didn't see anything. I guess I'm good. Give it a few minutes. But if you want a little more security or a little more convincing, turn on a 1-minute chart right before a half-hour and a 1-hour change and look at the volume come in. And just look at it 1 minute. It's as a normalized volume, 1 minute is just about the best thing you could ever want to use when I'm just volume here. I'm not talking, looking at price. It's an old school trick, before we had really fancy algos that could reconstruct order flow and all that crazy stuff. Just looking at 1 minute volume was the trick, right? All right, so we had that 2-bar reversal in Hong Kong, still closed inside day, but they kept the reversal, right? If we were to mark 50% of that candle, we didn't even come down and test against it. And we're still holding above that 50-cent level, but we are inside day. So this didn't form a bear sandwich, at least, right? We can say that. But we didn't get anywhere yet. So Japan found support and rallied back up after an inside day breakout, closing, I don't know, I'm not going to measure it here, but I'd say near to above the 50% mark of the previous day. The thing is, though, if we look at where we closed and then where we closed the next day and we measured that distance, then we're still nowhere near 50% of the distance moved yesterday. So 2 completely different concepts. So it's still weak in the near term, very short term. But as I zoom out here, we can see, use something like a linear regression tool. That the swing is still intact. So typical regression, swing high, swing low, swing high, swing low, we're ready for our next swing high. So we got a Haramni here on Europe. This is the FTSE 100. We finally broke down out of that range. And now we're sitting with this very classic shape. So we're inside day. We are less than 50% of the line. It's not overly bullish at this point. We need the follow through. But the pattern exists where it should exist, right? It's a good way to look at it. So this is the shape that we have right now. It's your bullish Haramni. If you're trying to remember them, that image right there should be, oh shush. That image right there should help you kind of try to remember the shape, right? Now, you know, where patterns show up has merit, right? It can invalidate a pattern no matter how good it looks just because of where it appears. If we're using this pattern as a reversal pattern, we would want to see it along the lows. If we're using it as a continuation pattern, we would want to see it at the highs. So we can see the same one back here. It was a part of the continuation, and now we've got it again. So just a little bit of a little note of caution is that this pattern is more powerful and more accurate as a reversal pattern and less accurate as a continuation pattern. As long as you keep that in mind, it's all good. All right, the volume is a little light, kind of implying that the jobs data today may be a little more impactful than FX Street implied with their gauge on, you know, the anticipated volatility. We're sitting at 82. That's on the lower edge of what I would deem appropriate. If we were to have been just a little lower than that, I'd be kind of nervous. The idea about this low volume, though, when we know there's econ on deck and we see that it's low volume, there's really nothing to be concerned about. It just implies that the econ that's on deck is great enough to keep investors sitting on the sidelines until the data comes out, so they'll wait before they act. That makes sense. But if there's no economic data points on the agenda for the morning session, and then you see the volume really light, that should make you pause right there and just call timeout and go looking around, see if you can identify why the market is standing on the sidelines waiting, find out what they're waiting on. That's not always easy to do, and sometimes you don't find an answer. You can look all you want and you can't find why they're waiting, but at least you'll know that they are waiting and that you can wait too, and just GTFO and wait for the fireworks to appear, right? Or at least just stand aside and not get run over. The ADR is still holding at 1%. It's a very narrow ADR. And I haven't had this discussion for a while, but it's worth bringing it back in again. So the other day we were talking about how the trading opportunities are getting fewer and fewer, right? That there's not a chance to trade as much as we were trading, say, 6 months ago. Before COVID hit, so you had COVID from the all-time highs and we dropped down, right? I'm sure you've all seen it by now. Before that hit, you were lucky to see the S&P move even 0.75% in one day. And we're talking about a 24-hour trading period. So from Globex 6 o'clock, 24 hours later, Globex 6 o'clock, how far did we move? Maybe 0.75%. If you look at the size of these candles, this was our normal trading day. So you were really lucky to get 6 points in a day, and you had to hold on and carry that sucker through a grind through the day to get those 6 points. So why am I bringing this up? Well, a lot of newer traders have never traded in any environment other than after COVID hit. High volatility, big sweep days, 1.5%, 2% moves. That's not the norm. It's just your norm because you haven't traded in anything else yet. But really consider the kind of trades that you take, because at some point we're going to be back into an environment where, you know, a 0.5% was the day for multiple days in a row, and that you'll be ecstatic and talking about how great the day was if you just actually get a 1% move on the day. So you have to change your entire approach to how you trade, right? The ADR is right now at 1%. So the average daily move normalized over the last market month puts us at 1%. So from 6 o'clock Globex open, we could move a 0.5% higher and lower, or we could move 1% in either direction and it would be normal. And that's where these two lines come in. This red line, 4106 and 4064, that is 1%. In the middle is where we opened in Globex. So 0.5% higher or lower. Going to the yellow line, 4027, that's a 1% move, or 4043, that's a 1% move. We did get a nice little expansion yesterday, inside day breakout. We're just now getting back inside the Tuesday rundown. If we bring this back out onto the daily for a moment and we look at Tuesday, there's some levels in there that might help you out. So 4125 is 50% of that day. It will be worth marking that out if we can get an inside day breakout to the upside. So if we get above 4116, for an example, then we got 4125 to deal with. Past that, we do have these 3 bars here, 4130-ish, that's a cog line. So right when we get up into that zone, these lows, we're going to have to worry about that cog line. On the other side of that cog line, we're pretty good to go at that point. 4150 round number would be the next level of concern, right? So we're able to lay them out just step by step. But it's first going to have to start with the idea of this really big bar, Tuesday's bar, and the 50% mark. Yesterday's high yesterday's open, and you could mark out the 50% of yesterday. There's nothing against it. I've just never really found a lot of weight to it unless it's a bar with some significance behind it. And I guess while we were out there, we should have just went ahead and looked at the week. All right, so we already have the week marked. It was marked by another pivot point, so no worries there. 41.16. We already covered it with another pivot point. That's confluence, by the way. When your pivot points line up with each other like that, and you approach drawing those pivots from different locations, but you still get the same answer, that's a good thing. 10-day, 30-minute volume profile. When we're at the highs, we expect to go to the lows. When we are at the lows, we expect to go to the highs. We fell through the shallow area and we set a low. Now for any move back up, we got to get through this structure built at the roundy 4100. That's going to be a significant level of concern and like a demarcation line we have to get across. But if we can get across it, we'll just aim for the point of control again, 4150. We had a VPOC from yesterday, but we tangled up in it here in the last hour. So no reason to mark it out at this point. We still have one underneath us at 40.43, and we still have one over our head. Call it 41.80. So I mentioned that 4100 is going to be a difficult area to get through. You can see a lot of volume here from Tuesday, right around that 4104, 4103, 4102, 4101, right? That whole area. And then yesterday, same area. The point of controls don't line up perfectly, but they're in the same zone. And we're talking about a 3 or a 4 point zone in a $4,000 product. So I wouldn't, get too hung up on to the tick levels. This whole area just has a ton of volume there. And at this point, it is volume, not orders, right? We'd have to bring up like order flow tools and approach it from another direction if we were going to look at supply and demand issues. All right, so we are still underneath the 10-day. We're talking about a rally today in the S&P. So with that in mind, we want to put the 10-day back on the chart, because if we rally up today, we're going to interact with it. Depending on your broker, this isn't going to be, a complicated thing. On Thinkorswim, just type in the word daily. You get daily SMA. Put that on the chart. All right, that's at 41.45. It's a wee bit over our head at this point. Maybe we'll come into contact with it, tomorrow. We could rally up and hit that. Just it'd be a bit much, right? The ADR right now is 41.27. So getting up to 41.45, a little bit of a reach. So it's not that we couldn't hit it today. I don't see that it's going to be as, for some reason I was thinking it was just a little bit closer than that. Since I'm already here, we'll go ahead and do it. There's the 10-week at 40.56. So same thing, taking your weekly moving average and putting it on your intraday chart. Sorry, something's bugging me. I want to see why. That's what I thought. So we were looking at the SMA here, the indicator that I use to see how high we are above or below the 10. It's using the EMA, not the SMA. So the SMA is a lot farther away, and that's why it looked like it was a lot closer when we were looking at the indicator. But when I came over here and actually plotted it on the chart, it was a lot farther away. Okay, so now the little bubbles tell us which one is the EMA. And we can see that the 10-week, or excuse me, the 10-day is right at our ADR. So if we get up to 41.27, it's going to be a real fight to get through that level. There's some value to that if you're trading options, right? The idea that we're very unlikely to get through that zone unless we get some fantastic news that really galvanizes the market. And that 40.84.5 is the 10-week using the EMA. You can see how we interacted with it yesterday and it didn't hold, so we broke through it. Then we interacted with it in the Globex where it was more like a magnet, and now we're above it and we're through it. Less than 0.5% above the 10-week at this point. So Thinkorswim does have the VIX 1-day now. This is that new CBOE product designed to kind of assist with 0-day and really front end trading. On the first day that it came out on Monday, you couldn't access this on Thinkorswim, but you can now. So yay. All right, so the dollar had a pretty fast move yesterday, trying to recover back up like the rest of the market did. It just happened to have made the move early in the day. And then it took the market a while to kind of wrap its head around it. The idea, though, here is the line in the sand. We didn't get a below the 101. So that's going to be the level that we want to continue to focus on. If we use that linear regression line, we can easily see the direction of this thing, right? We continue to set these lower highs and lower lows. In the bigger picture, the swing continues. Now, generally, we're going to see reciprocation, right? So if we see 0.5% on one side, we get 0.5% on the other. If we get 1% one way, we generally get 1% the other way. So we had a pretty solid swing to the downside, which we have not seen reciprocated yet, right? We haven't got the other side. It doesn't always the move, right? So just because it did make a swing in one direction doesn't mean it has to the other way. We can see times where it'll get shunted and we just don't complete the move, and then it tries again. So here we had the move to the downside. We failed to get that big upside move. And now we're just kind of stalled out here. The dollar is primed to either start to base, right? We see price slowly come across and come back up the other way. Or this is just a consolidation before the next leg down. In the higher time frame, maybe we'd be able to identify, some structural levels. But right now, my main focus is on Tuesday's low between Monday and Tuesday, that Globex area. So down here. If we consider this just a really good double bottom, then that overshoot was a bear trap. And we're still looking for the follow through. So I want to see that follow through. And there goes the NASDAQ taking off like a rocket ship. We're getting a little bit of follow through in the ES, but nothing close to the push just came in on the NASDAQ. So far, everything is playing out between the TNX and the TLT. We had double bottom in the TNX and the double top in the TLT. The TLT is actually starting to expand already beyond the last pivot point, but the 10-year is not. So this thing is a little sleepy this morning, and I'm looking at this kind of wondering where is everybody? Why isn't this thing keeping up? So a little bit of concern here. I would continue to keep your eye on the bonds this morning. We really don't want to see them on the, at least say the TLT. We don't want to see it get back below 104, maybe 104 and a half at the most. Really, even the weakness that we're seeing already, that's bad enough, 105.5. But we're looking for an easier level to keep our eye on, right? This pivot point from Friday, it's Friday's RTH high, Friday's high, either way you want to approach it. We're back inside that level, which means also that we're back inside last week's level. That's last week's high, unless we had a high on. Yeah, nope, that's last week's high. So trying to maintain a bullish posture in bonds when we're now back inside last week's price action, it kind of takes it all away. On the other hand, though, we're still not seeing the follow through in the 10-year yet. Now, granted, these are, not exactly equal dated products, but I would continue to keep your eye on the bonds today, keep your eye on yields today, especially with Japan coming up tonight. All right, we got a continuation in Bitcoin again this morning, another 3.5%, closer now to 3 3/4. Gold up, emerging markets up, a little bit of tech, a little bit of finance. So really a lot of the same things that we had going on yesterday. So here's Mara. We had the pre-market rally up in this and a lot of other names yesterday. Now we're back up again. Riot. All right, so in Riot, we had this really nice follow through here, this TRB that was coming along really, really well until the 26th, right? So yesterday with this drop down. So here on the smaller time frame, you kind of see that follow through, a pullback to 786. Now that isn't any good. Let's flip this all around. I guess I had it right. So if we were going to continue the move, we wouldn't have wanted to see it pull back more than 786 before continuing lower. Now that we've already got through that zone, breaking out above it, coming back and getting a little bit of a Busby off of that thing before continuing on makes sense. So pulling back to the 786 from the top side is bullish. I don't like that it closed below it, but it did manage to, get back above it. So it's what we're working with this morning. But this now, as a lot of names you're going to hear me talk about this morning, it really needs to get through yesterday's high. And considering how big the move was yesterday, a lot of these names just aren't going to be able to do it. But when we're looking at the flow of what's going on out there, we've got your K-Web constituents. So JD, PDD, Baba, Baidu. Then we've got the Bitcoin names running this morning and your semiconductors. So AMD, NVIDIA. Yeah, Micron kind of took a gut punch this morning. I don't know. I messed with that one. Semiconductors through SMH and TSM. So that's a really nice TRB setup in TSM. All right, you got a nice base down here. We're primed for a reciprocation. Not so clean on a daily chart, but looking at it here on that 12-hour. Get back inside the channel at 83.3 and a gap close at 84.67. Those would be daily levels, at least, to focus on. So semis, China ADRs, Bitcoin constituents, or Bitcoin proxies. right? Tesla broke structure. We had talked about this last week. And the idea that if we opened the new week gapped down, I would be bullish. And if we opened the new week gapped up, then I would be bearish. But we didn't gap down the levels that we had talked about, right? That's a minuscule gap at all. It's hardly nothing at this point. And so far, the continuation to the downside is looking really good. So the levels that I would focus on take us back to January. 144.2. Just a second, guys. All right. So a note of caution: when a market runs in a particular direction for too long, it's going to pull back and go the other way. But at this point, it's not slowing down. It's not stopping. It's not even giving any signals that it's ready to pause yet. So even the gap up was taken right back out again. Focus on inside day breakout and continue the expansion to the downside. 144 and then 134. And that would get you to the bottom of this candle. There still has to be a note of caution, right? That a market's not going to just continue to go to the downside. It's going to hit support and rally off of that support up into a resistance level before rolling over and making the next leg down. So, just kind of keep that in mind. So we've got everything. XLF and XLK combined. The only thing that we don't have is consumer discretionary, and that's because of Tesla. So when we think of the risk on, risk off sectors, the risk on, risk off grid that we use, it generally is a 9 grid setup. The top of the grid is risk on, the bottom of the grid is risk off, the two in the middle, midline sectors. So these three here, XLF, XLK, XLY, these three make up the risk on sectors. If you're going to have a bullish day, you need at least one really strong or two. And generally what we get is a little bit of finance and some consumer discretionary, or we'll get a little bit of tech and some consumer discretionary. But consumer discretionary is Tesla. So we're not going to get any assist out of that. What we've seen a lot lately is tech versus finance. And now we can't have that. We're going to need both tech and finance to overcome the negativity in consumer discretionary. You got to have it. So I would look for this. You can use KRE and say NY Fang. It's generally what I use, right? NY Fang. The only issue is it doesn't start until 9:30. But KRE is at least open in the pre-market, and we can see we're up in that. We're up in financials, XLF. And Apple still needs to report. Kind of keep that in mind too, right? But right now, all eyes is on Japan for tonight into tomorrow. And the main thing we're focused on is just the inside day and whether we're going to be able to reclaim even half of that move. So far with everything bullish, it's not bullish enough. So what we're looking at here is how many names in the S&P are up at least 0.5%, 36. So that's pretty good. And they're technology names, right? If we're looking at what industry they're in or their sector, electronic technology, finance, technology. Kind of feels a little bit like a trap. All right, I'll leave you guys with this. There's a move that we see sometimes in the futures that I kind of like to pay attention to. The way it works is we set this high in the Globex, and then we pull back away from that high, and we go into the RTH open a little ways off from that high. Not drastic, but a little ways off from that high. Then we get into the RTH and the market rallies back up and tests against it, maybe overshoots it a little bit, and it's a bull trap, and then they drop it down on our heads. A little bit like yesterday, but no, this high had me thinking we were going to get the same setup, especially when we sold off well. But then we had this, and it kind of just threw the whole thing away. So you want that pre-market high. You want to get away from that pre-market high. It doesn't have to be a massive amount. And hold that into the open and then see a run for it to get a test and an overshoot. Now, it looked like we were starting to get that set up, and then we already ran back up again, and we've already overshot it. So that kind of throws the whole thing out the window. Just this run is not making me all that exuberantly excited, right? Look back here, same kind of situation. Nice run in the overnight hours. Everything was looking really bullish, got into the open, and down we went. So just the fact that we're, getting some reasonably decent moves this morning in the pre-market, it's looking really bullish, it's looking good. Don't get sucked into that trap. Keep your levels from yesterday and from Tuesday. They're really going to help you out. The RTH of yesterday, the RTH open, mark that level out. It's a level of importance. Then just your regular open, high, low, close from Wednesday and from Tuesday, and really lean on those levels. All right, everybody, be careful, be safe, have a good day. I will see you all tomorrow.